Our classroom stock portfolio now has an annual return of 19.17%. The portfolio has broken the $2,000 level and is now worth $2,067.93 after 127 weeks. Hi, Professor Rex here. We are now almost 2.5 years into our class project where we invest a total of only $12.50 per week and split it up to buy 10 different dividend-paying stocks. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,067. The portfolio's return has been 19.17% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year. So go check out the source link that I include at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing separately. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate in income from qualified dividends that would be federally tax-free. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you do not need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases at least by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For a classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is a Schwab U.S. Dividend Equity ETF, ticker SCHD. And a lot of dividend investors always compare their portfolios to this ETF. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is over $2,067. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,789, a difference of 15.6%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio stocks. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps, and that's not a good thing. This slide shows our best performing stocks based on when they were initially purchased. This week, chip equipment manufacturer Lam Research is back on top with 156% total return in 20.5 months. Applied Materials also moved up the ranks and has more than doubled in 2 years. New to the list is ASML, which has provided a total return of 58% in less than 14 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% or more of our investments made in this portfolio were made in these dividend-growth stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% or so of investments that we've made have been invested in usually smaller, under-the-radar dividend-paying companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. On this slide, examples of under-the-radar dividend payers are F&G Annuities and Repositrac and Crane Holdings. This slide shows our best performing stocks this week. The best performer this week was Nvidia at 10.3%, followed by ClearSecure, ASML, which is now one of our top performers as we saw on the previous slide, Broadcom, Meta Platforms, Air Products, and Bolero, another under-the-radar dividend pair. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago, along with their total returns, which of course includes dividends. Domino's Pizza is the best performer of the stocks that we bought that week, so far providing a total return of 71.9%. We still own all the stocks except the stocks in yellow. Now, most of these stocks were purchased over multiple weeks, which is why many have appeared in recent videos, but this slide only refers to the investment made a year ago. Now, we sold Fidelity National Info Services because they cut their dividend. This particular purchase of Fidelity provided a total return of 29.4% in less than a year, despite the dividend cut. We sold Williams-Sonoma, Agilent, and Robert Half because they appeared to be fairly valued. The average return of the 10 stocks we bought a year ago is 42.39%, despite 4 stocks not being held the full year. The annualized return for all 10 stocks is 48.9%. Obviously, our purchases won't continue that high rate of return, but it's a great start for our portfolio. Now let's talk about the dividend growth stocks we bought this week. Here are my ratings for the top 15 dividend-paying stocks this past week. They are Comcast, MasterCard, Visa, American Express, Allegiant, Masco, Microsoft, Northrop Grumman, Huntington Ingalls, Broadcom, Skyworks, Lockheed, Evergy, PepsiCo, and Gilead Sciences. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, and remember we started with $12.50 per week, it means we are taking that small investment and buying fractional shares of each company in our Fidelity brokerage account. And for those of you that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that might be in the account at that time and are just sitting there in cash. We then take that combined total and split it up amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on the broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Comcast, Allegiant, and Gilead. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields on this slide are Gilead, Evergy, Pepsi, and Comcast. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or more of our purchases. The other 10% or so far have been invested in smaller under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies for the most part, but studies have shown that they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a long history of raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And remember, earnings is just a fancy word for profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Evergy and Pepsi first, followed by American Express, Microsoft, Huntington Ingalls, and Broadcom. Remember that the risk rating on this slide is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings for this week are MasterCard, Visa, and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Broadcom, Skyworks with an A+ ratings, followed by Comcast and Evergy with A ratings. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Comcast, MasterCard, Visa, American Express, and Microsoft. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, MasterCard, Visa, and American Express. On this slide, we're looking at stocks in our portfolio that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expense, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, United Health Group raised their dividend 11.7% and Lowe's increased their dividend by 8%. Ideally, we want our companies to raise their dividends higher than 3%, which is the historical average of inflation. And on this slide, it's showing that the last 17 dividend increases for the portfolio have an average increase of 17.5%. And this slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once the stock split has occurred. Here's a look at the top 10 stocks that make up the largest portion of the portfolio as of Sunday. Microsoft is back on top with Schwab a close second. They're both at 4.2% of the portfolio. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in just the top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio. And many investors, especially new investors, cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are at 95. That might seem like a large number of companies to keep track of, but the spreadsheet that we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So, in August of last year, we started investing $12.50 each week into stocks with higher dividend payouts. Currently, the portfolio's dividend yield is 4.46%, but the companies in it likely won't grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. The portfolio as a whole has an annualized total return of 29.65%, which is higher than the S&P 500. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth and is the better performer of the two strategies. The average investment in this strategy has provided a total return of 13.31% and those stocks have been held for an average of 144 days so far, which is an annualized return of 37.2% using Excel's rate function. There's no way that this portfolio can keep up an annualized return that high, since stocks historically average about 9 to 10% each year. And as I mentioned earlier, this portfolio has even outperformed the dividend growth stock portfolio that we featured on the previous slides over the same time period. On the next slide, we'll look at the high yield dividend paying stocks we bought this week using those two different strategies. Now, strategy 1 on the top emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are two different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it up between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2, and that often happens. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought this week while implementing the superior strategy 1 are Chevron, Interpublic Group, Gilead, and Pfizer. And the 4 high-yield stocks we bought this week while implementing strategy 2 are Evergy, Gilead Sciences, CVS, and Medtronic. This week's purchases have an average yield of 4.5%, with Pfizer coming in the highest at 5.9%. And here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stock with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me: X, LinkedIn, beatthestockmarket.com, and of course, YouTube. We'll talk to you next week.